Okay, I'm Dan Fitzpatrick at stockmarketmentor.com, and it's 2:35 p.m. Pacific time, October 1st. The government shut down, and frankly, the market didn't care. Um, Here, we'll just start here. I got a couple things to show you, but so the S&P and the Qs, that's something else. The S&P and the Qs closed at all-time highs, so there's that. But what I wanted to show you today was Amazon. Okay, this has been kind of trading sideways for a while here. You can see what's kind of looking like the potential to be a double top. It's not really a double top. Actually, from a purely technical standpoint, it's really not a double top until the low between what looks like the first top and the second top, until that low is actually surpassed. So it would really take until this. It would take this stock to go clear down below 170 before you can conclude that, oh, that's a double top. Maybe I should get out. All right, that's not the way to really trade. You can trust me on that. But if you look at the daily chart, you get kind of a better sense. First of all, I don't think this is something that you got to rush out and buy right now. However, if you are a longer term trader, this is a pretty good opportunity to take what you would like to be a long-term position and start as a short-term trade. In other words, you've got this stock here right at the 200-day moving average. I got a lot of notations in here from trades that we've been making. I'll get rid of those. So you've got this trading right along the 200-day moving average, which really doesn't happen that often. Back here, yeah, like everything else, this fell down, but ultimately it just resumed its ride right along the 200-day moving average. So if you're a longer-term trader or investor, you're buying the stock here at 220, but your drop dead level is really, really low. Like you've got not even 4%. You can keep a pretty tight stop on this at about 3.5% on what you're hoping will be a very long-term hold, because you're able to get the stock at the 200-day moving average. Now, this trade isn't for everybody. If you like to be kind of a short-term trader, kind of a swing trader, there are better trades than this, but this is just one of them that I'm showing you. One other thing though that I wanted to mention, and this has to do, it kind of dovetails into what I'm saying here with respect to risk. So let's say you're buying here and you're going to put your stop down here. So you're risking 3%. You can see that in the upper left-hand corner. You're risking 3%, and you need to really make, in order to make it worth your while, not 3% on the upside, but like at a minimum of 6%. So you'd really need to see it go above 230, like to 233 or 234. Ideally, if it's 3, you want 9%. You want to get a return of $3 or 3% for every percent that you risk. And so that would put it at 240. So to round this out, if you're going to make this trade with a stop down here, your assumption has to be, in making the trade, that the stock can at least get up to, look, maybe 233, 234, but really it needs to get up to 240 in order to make this a good trade. I don't know if that's your trade, but it is a trade. One thing I want to show you here, and this is on Trade Track, which is a tracking software that I have. You'll notice here, R's. What does this mean? Well, I already explained to you here. What is your risk? In this case, what was it? We'll say it was 3.5%. Okay, so that's the R. That's the R multiple. So if you're getting 3.5% to the upside, that's an R1, an R multiple of 1. This is Van Tharp's analysis. And if you're going to get twice what you risk, that's an R2 multiple. The idea is, and I'm going to be teaching this at in Las Vegas in a couple days at the Investors Business Daily Founders Club conference. Hopefully I'll see you there, but probably not. Anyway, I'm going to be talking about the importance of trading according to risk as opposed to money. I mean, if you're managing your risk well, the dough's going to come. That's just a consequence of being a good risk manager. And so it really starts with risk first. And what you're looking for are really, really high value trades, trades where the R multiple isn't 2 or 3 or 4. It's like frickin' 20, stuff like that. And so this is what we've got going on our active trade list right now. Now, if you're a member, you know this already. If you're not, listen up. Okay, this is the way I track our trades that I've got going here. And according to our multiples, we've got Rigetti here with an R multiple of 23. Like, this has been a monster trade. Why? Because we got in it at the right time. And now I've got the current stop up here. Fine. That's to lock in some profits. And you can see this with some other ones too, like AppLovin, similar kind of thing here. We bought it at the right time. We've got a trailing stop on this, and we're doing really, really well on this. It's a 15, almost a 16 R. Now, why is that? Why do we have such a high R value here? It's not because of where we entered. It's because of where we were able to put the stop. We were able to take a small risk in order to get into the trade. And then when the trade started to work, that's when we really started banking the reward for the small risk that we took. Now, if you had to have a really loose stop for whatever reason, and sometimes you do, just with the respect to volatility, if you had to have a really loose stop, you're risking a lot of money. So let's say you had to have a 10% stop. Okay, then in order to even get a 1-to-1 reward versus risk, you have to make a 10% profit. In order to get a 2R, you have to make 20% profit. To get 3R, which is really what you kind of want to shoot for, you got to be making 30% on that damn trade just to make a 10% risk worth your while, worth your money. Are you tracking me? Because this is what I'm talking about. You have to trade risk first. And here's the thing, if you're trading risk first and you're always taking a small amount of risk, hey, it's an inevitability that you're going to be stopped out. You're going to get shaken out of trades. You're going to get shaken out of trades that then you go like, oh crap, I got to get back in. And then they ultimately work. That's the nature of trading. I don't care about getting shaken out of trades for a 2 or a 3% loss, but I sure as hell don't want to get shaken out of trades for a 10% loss or a 12% loss or something like that. You can't get that many shakeouts before you really start shaking, pardon the pun. It's kind of a stupid one, but it just came to mind. So the point that I'm making is, if you start with risk first, you are going to get some massive R multiples, and your account is going to increase exponentially. I promise you that if you start trading risk first. The one caveat is that you have to have a sound trading strategy, which, by the way, I teach every day at Stock Market Mentor. If you're not a member, you're missing out, because I teach these strategies. I go into this stuff in detail, and I got to tell you, I'm really enjoying the feedback that I'm getting from members who are making a crap load of money on the trades that we're making. Like, these are just the open trades. I haven't quite updated it, but actually just a couple things I need to take off, like JP Morgan, a couple others that just aren't working that great. But look at the returns on this. Okay, these are monster trades if you are just looking at the risk. And so I'm pounding the table here just a little bit to tell you, if you're not trading risk first, you're trading too risky. I hope I see you in Vegas if you just kind of happen to be over there. We're staying at the Venetian, my wife and I, so look me up. You can just send me an email or something, Dan, Stock Market Mentor. If you're getting this, like to have a drink with you, okay? That's all I got, ladies and gentlemen. I'll see you next time.